Good afternoon, ladies and gentlemen, and welcome to the African Rainbow Minerals interim results for the 6 months ended 31 December 2025. All attendees will be in listen-only mode. There will be an opportunity to ask questions when prompted. If you should need assistance during the call, please signal an operator by keying in star and then 0. Please note that this event is being recorded. I will now hand the conference over to Thabang Thlaku. Please go ahead.
Thank you very much. Good afternoon, everyone. So we're all together in the room here. I've got the entire management team. We've got Philip Tobias, Tulu Mhlanga, Mike Schmidt, Jacques van der Bijl, Thando Mkatshana, Marika Berger, and Johan Jansen. So the entire management team is here to answer all your calls. We're not going to do an introduction. We're going to go straight into Q&A. So we'll just give them some time to take it, and then we'll go straight to Q&A.
Thank you. Ladies and gentlemen, we will now be conducting the question and answer session. If you'd like to ask a question, please key in star and then 1 on your telephone keypad. A confirmation tone will indicate that your line is in the question queue. You may key in star and then 2 to exit the question queue. Just a reminder, if you'd like to ask a question, you're welcome to key in star and then 1. We will pause a moment. Our first question comes from Ntabogang Segone of Investec. Please go ahead.
Hi, team. Just a quick one. Can you guys hear me?
Yes, we can hear you, Thabo.
Oh, perfect. I think my question is quickly on Thando, to Thando, in relation to the call. I mean, I see domestic sales were down 15% year-on-year at GGV, and then PCB also was down 3%. And then I also see on the revised guidance, particularly around those local sales volumes going forward, they've been revised downwards. Could you please just provide some guidance on the contracts and downward revision of that coal business and how we should then be looking at it, particularly on the local sales side? And then in relation to Modikwa, I just wanted to understand. So I saw that tons milled were up 5% year-on-year, but the PGM concentrate did go down by 3% due to that plant recovery. How does the recovery's outlook profile with open pit combined look like for Modikwa? And if you could maybe speak more around that 4% unit cost reduction at Modikwa and how we should also look at it going forward. I'll leave it there for now.
And Tammy?
Table.
Yeah. Or a bigger iron table. And with regard to the domestic sales, those are the main supplies to Eskom. As you probably know, the burn rate in terms of Eskom and power generated from their side has been reducing. So we are having that impacting our domestic sales. The positive thing out of that, obviously, and tying up with the improved performance from TFR, and some of that coal we do divert into the export market at opportunity prices. So in terms of our contract with Eskom, we are contracted for a GGV. It's about 2.5 million tons at 100% for the full year of sales. But yeah, we all depend on whether they are responsible for the entire logistic as well, in terms of getting trucks through and picking it up. But from time to time, when they don't use or or take that call with derivatives into the export market. I hope that kind of answered your question.
Yes, thank you. Sorry,
Yeah,
and the water accumulation there in the coal business there with Mpunza, how will that impact production going forward?
Yeah, that's simple. Maybe a bit of quick background is that used to be an old underground mine where we're mining now. So we are mining those areas through an open cast method. And we had a net accumulation of coal. We have, that has been, I would say, maybe a once-off matter. We have since revised the pit layout, and we've added additional pumping capacity. Having said so, though, across all our business, I think the rains that we have been experiencing in the last 2 years has been somehow a bit more than the normal range. So those have an impact from time to time. But in the main, the challenge of the water accumulation has been addressed for now.
Thank you.
Thank you.
Zihan, will you take the Modica question?
Certainly. Good afternoon. I must state that the open cast is not the preferred source of ore for Modica. We're putting that through the concentrator while we are building up the reserves underground in the UG2. The 6E grades for the underground UG2 is 4.76 grams per ton. While for the open cast it's higher, it's anything between 5.2 grams a ton and 6.5 grams a ton. The challenge, however, sits with the recovery. Typical recovery for normal underground UG2 is sitting at about 84.5%, 85%, while the open cast closer to surface, highly oxidized, can be sitting between 50-54%. The benefit of the open cast is that it's a much lower cost operation. UG2 cost per 6E ounce comes in underground 20,200 rands per 6E ounce, while the open cast comes in at 16,000. So although you lose some ounces, you're seeing the benefit in terms of the cost. We are going deeper with the open cast, so as you are proceeding deeper, the ore becomes less oxidized and your recovery goes up. So we are confident in the outlook for the open cast as a temporary gap filler at Modica. Thank you.
Thank you.
Tabahang, does that conclude your questions?
Thank you.
Thank you. Yes, it does. For now.
Thank you. Okay. Ladies and gentlemen, just a further reminder, if you'd like to ask a question, you're welcome to key in star and then 1 to place yourself in the question queue.
Operator, should we just let Ntebogang ask the rest of his questions? Okay.
He's just been cleared, and we do have a next person in the queue, which is Tim Clark of SBG Securities. Please go ahead.
Thanks, everybody. Can you hear me?
We can hear you, Tim.
Thank you. All right. I've got a few questions. I'll sort of roll through them slowly. Let's start with Beeshoek. The finished stock that you've agreed to sell, the 1.2 million tons. Can you give us an idea, please, of just the sort of time frame over which you'll sell that, what the offtake is, what the contract is?
Marika? Yeah.
Hi, Jim. Yes, so the contract has been concluded for 1.2 million tons over a 12-month period, which started in February. So the intention is to offtake 100,000 tons per month for 12 months. Thank
you. That's very helpful. Thanks very much. let's talk about just how we should think about Nkomati going forward, just in terms of spend. You've got this chrome plant, which is going to give some kind of revenue credit. How should we think about it? You've got the liability outstanding. Can you give us like some kind of sense or guidance just for our models for the next, 2-3 years of what we should model in terms of how we should think about Nkomati in terms of the plant and then offsetting and the spend on rehab, please?
Tim, thank you for that. I will also ask Sue to help in terms of the rest of the rehab. But to an extent, this COM, as you correctly pointed out, this COM revenue subsidizes the cost of care maintenance, which, as we have indicated in the past, it will then a month, I think we going to be generating between 20 and 25 million of revenue that will come and subsidize that cost. So I'm not sure if I've answered. On the rehab side, did you ask on the rehab in terms of modeling? We are currently not really undertaking major rehab because we are completing this feasibility study in terms of looking at optionality going forward. As we have indicated, we have quite advanced on that, and I think it's very encouraging, and we're confident that when we take it forward to the board, it will get approval, and they will make an announcement in due course. So there's no really major rehab that's happened, save for the water treatment plant, which we have indicated in the past.
So is that going back to the
commission?
Okay, so that feasibility study, is that to open
Have you broke for a second?
Another version of the nickel? Sorry, is the feasibility study just to open up another nickel mine, effectively, a new Nkomati in some different form? Sorry, I don't know much about it.
That's what it will entail. It will entail really recommissioning the mine and bring that to life. But obviously, in a much more, let me say, remodel at a maybe a smaller scale than previously. That's what we are looking at. But we'll be able to share the details in terms of the actual volumes and so on after we've finalized that study and taken it to the board. But I think that gives you a good indication. And in line with that, obviously, also with the very encouraging corn prices, we are looking at a potential a bigger corn production than what we are currently doing.
To add on the rehab liability.
All right. Thanks, Thando.
So that rehab liability. Sorry, Tim. Sue's just giving more color on the rehab liability.
At Nkomati.
At Nkomati.
Thank you.
So just to, thanks, Tim. Just to let you know, so that rehab, as at 31 December, for Nkomati is just over 2 billion. So it's 2011 million, or 2.0 billion. But then just remember that we did receive the 325 from the RILSC, which was their contribution as part of the transaction towards the rehab, water specific. Yeah, water rehab.
So sorry, it's Tabang.
Thank you.
I want to ask additional questions on your behalf so we can just clarify some things. With Thando, so current monthly production of chrome, where are they now and where are we planning to sell?
We are around 8,500 tons per month. That's what they are achieving. But so we will peak at about 11,000 tons per month of corn concentrate.
It's steady state.
With the current project.
Okay.
Yeah.
Okay.
The bigger stage, we're still finalizing a few items related to the metallurgical recovery process, and that one will communicate those volumes, but they are much higher than the current project.
When do we expect to get to 11,000 tons per month?
I will get 11,000 tons per month in the month later.
In April.
Yeah.
And what kind of profit margins are we seeing with the corn production at Nkomati, more or less?
That plant, it cost us about 10 million. So I just want to check my numbers and confirm that. It cost us just under 10 million per month to produce. And it's that 20-25 million. So it's between 15 and 10 million, dependent obviously on the corn price.
Yes. Okay.
I think maybe just to come in overall, just correct me if I understood well. I think in the next 12 months we should be able to make at least a profit of 100 million with this 500,000 tons.
That's correct.
Delta will be 100 million positive.
Yeah.
It's revenue or profit?
Profit. Yeah, it's very speaking, as I said, 10 and 15.
Yeah. And then just to add, with regards to the broader Nkomati question, I think it's too early for us to give too much information. As you can imagine, with the geopolitical changes that have been happening, there are some off-takers who've been looking for nickel supply out of Indonesia because of their relationship with China. As a result, Nkomati has become a little bit more attractive to other nickel producers. But it's still early stages. We're doing the study, and we're only sort of going to go for board approval later in the year. And once we do have the details, we'll come back and guide the market accordingly.
Thank you very much. I'll ask one last question, please. Just on Two Rivers, I was just reading your commentary about being impacted by sympathetic geological structures. Never heard of those before. Can you just chat to how long it's going to take before your productivity improves as the geology improves? Just how long, you sort of spoke about it improving over time. Now that you're getting past the dikes, maybe you can just give us some timing. Thank you.
This is Johan Jansen. What we encountered was a fault parallel to the advancing phases. So about 18 months ago, we started intersecting the fault. We've done redevelopment, went through the fault. We've established the phases on the other side of the fault, which was quite an effort. And at this stage, we are busy bringing the supporting infrastructure up to date, the conveyor belts, moving them back to within 60-80 meters from the face. We've already seen an improvement in the productivity, and we will continue to see that over the next quarter. And by the start of the next financial year, we will be back on 320,000 tons per month.
Thank you very much.
I think, Tim, that's what I said. That's what I said. Our forecast for F27 will be an improved output because we'll be moving towards strength out of these geological features.
Thank you, Philip. Thanks.
Thank you. Ladies and gentlemen, just a final reminder, if you'd like to ask a question, you're welcome to key in star and then 1. Our next question comes from Dubela of Nedbank. Please go ahead.
Hi, good afternoon, everyone. I did get cut off a few times. Please forgive me if I do ask questions that have been asked already. Earlier on during the webcast, Mariki talked about the value in use model when I asked a question about the realized pricing on the manganese. Could you just expand some more? what is meant by value in use? How does that potentially improve your realized pricing? And it did seem as though
Hello.
she was... Hello?
Yeah, it's not please.
Can you guys hear me?
Apologies, Tabela. Please continue.
Oh,
Yes,
okay.
we can.
Okay. And it did seem as though she wasn't just talking about just sort of the manganese operation, but this perhaps could be applied in other divisions. Can I just get clarity on that as well? So that's my first question, and then I'll ask my second question later.
Tabela.
Yes, I would like to expand on that. So what a value in use model is you take your specific ore, and you are correct, we're going to do it for manganese at Blackrock as well as iron ore at Kumani. And it is tested in various applications, so where it would be used in different smelters and for what purpose in that smelters. And you develop a model to determine the intrinsic value of your ore type to the customer buying it. And through having that value, you can maximize the economic value you get back in your pricing. And to just further explain it, obviously in a smelter, they don't only use your specific type of ore. They would use different suppliers' type of ore, which has got different grades and contaminants. And we know Blackrock, as well as Kumani, has got a very high grade reserves. And we are doing this work in specific to ensure that we get the net back per product on maximizing economic value. So it would mean that we would receive above an index price realization for premiums for our specific product based on our product's value.
Okay. No, that's
Marita,
that's
the
clear.
other question you asked was,
Go ahead, Taban.
did you answer if it also applies to iron ore?
Yes, it's for both.
Yeah. Thanks, Mary. Okay, so then I'll go to your next question.
Yeah, maybe just to follow up on that is, would that then maybe mean that your sales volumes, perhaps, because you may, would your sales volume remain the same in terms of how you are focusing currently, or would this value in use, kind of affect your sales potentially, given perhaps you may have to change your product spec there and there?
No, it would not have any impact on your volumes. The only impact that it would have is on your revenue line. The intent is to see if we can get better prices due to the specific ore type, and we can engage on that. So no, volumes will remain the same both for Blackrock and Kumani, which is currently in the 5-year plan.
Okay. And then my second question is around the domestic sales in the iron ore division. I think my question, I guess, is you've talked about having signed a new contract to sell for domestic sales. Where would those, given that Beshoek was the one that used to supply to your domestic markets, so I'm guessing Kumani will be now the one supplying into that. And is that, my understanding was that your export sales, you derived better revenue there versus perhaps on the domestic side. Could you just clarify as to why perhaps go via this route? Thanks.
So to be for clarity, the contract on Beshoek was signed with AMSA, and it was for 1.2 million tons. We're sitting with a stockpile of 1.48 million tons. The only reason why we signed a contract with AMSA, and it is not at a brilliant rate, it's 800 rand per ton, where our previous rand per ton on Beeshoek was 1,221. So you can imagine it's 25% lower than our previous base price. That's the best option we could get to get some value for the stocks currently lying at Beeshoek. The intent is never to supply the domestic market from Kumani. No. Kumani is an export mine, and our revenue receiving from exports is much better. So yes, the domestic market will definitely not be supplied by Kumani. This is an isolated matter in specific pertaining to Beeshoek being on care and maintenance, and we having that 1.48 million tons of stockpile.
And maybe just to come in, Tebelo, I mean, just a bit of background. You remember that at some stage we said we don't have a long-term contract with our sole customer, that we were still busy in negotiation with them. And then the last basically delivery of all was done in July, during which period we were still negotiating. And that was at the back of the November 24, where they announced the potential shutdown of the long steel business. So that being announced November, they were still taking some product for us. And with us being in the mining, obviously you have to be producing, delivering stockpiles so that you can really, deliver whatever quantities that are required. So we, at the back of hope that we were going to enter into an agreement, we still carried on and mining, and we only drew the line on the sand, end of October. We said we cannot carry on. At that time, we've already accumulated 1.486 million tons. So we just have to basically sell this and clean up everything at Beeshoek.
Okay, no, that's helpful. I have my one last question on Two Rivers. I think if I recall well, in terms of your ramp-up profile of prior to the Merensky project being put on care and maintenance, it was quite significant, just in terms of what was anticipated then. And then if I look at the current ramp-up profile with the Merensky project being sort of pulled back again into production, this ramp-up profile seems a bit softer. Could you just explain, what's the thinking now versus before you put that particular project on care and maintenance?
I can just take that. On the Merensky project, like we communicated earlier today, we started with the decline development in October last year, a limited development, whilst we just finishing the feasibility study to recommence with the project. And we plan to complete all of that work as well as the review work and third-party work by May this year. And we'll take it to the partners for approval with planned restart date of the 1st of July. The current, we have redone the whole life mine model and optimized the mining cuts, etc., to get the best value out of the project and extracting the resources at the maximum grade. And with this latest ramp-up schedule, the schedule that we've done, we ramp up to 200,000 tons per month over a 3-year period. So it's from July, 3 years forward, we have steady-state production. We are benefiting now, obviously, from the fact that we've already got 3 levels developed, and we are proceeding down towards level 4, of which 2 are already equipped. So we do have quite a big head start compared to the original feasibility study.
Yeah. Thabela, Tu just actually made me aware, when you're looking at our PGM forecast, the Merensky numbers are not there. So you can't compare this to the numbers, say, that we gave you in 2024, because we're still to include that once goes through the government. Yes, once the governance process is done, then we'll be able to the Merensky guidelines.
I'm actually looking at the year before that, 2023, where at the time the Merensky project was due to come in online. And then if I look at your ramp-up profile then, I have it right in front of me. I think from 23 to let's say, well, from 24 to 25, you're going to move from 313 cores to 485 cores, well, kilo ounces. So that's that big jump versus perhaps, I guess, the current softer profile.
Yeah, but that's because those numbers did include the Marinsky estimate, and these ones don't.
Okay,
Yeah,
so
if I can add, I think we haven't disclosed in the current results. Yeah, and we haven't disclosed in the current numbers the Marinsky ramp up, like the Bong and Sue rightly say that we're still busy with that governance process. However, I can share that the work that we've done with the mining schedule, that ramp up is over a 3-year period. So I think it's substantially still in line with what we guided before.
okay. So in the
And just to help you, Tibble, I mean,
go ahead.
just to help you, just to clarify, I mean, remember what Jack said. Where we stopped in August 24, we were already at level 3, and this is going to be a 5-level, operation, delivering 25,000 tons per half level. So we need to develop to level 4 and to level 5, and that is basically going to take us about 2 years to do that. Then the third year that Jack is referring to is when we ramp up to steady state. So which is basically from the beginning, it will be a total of 3 years to get to steady state.
Okay, because I guess my understanding was that the bringing back of the Marinsky project would take a lot less time than what I'm hearing now. I guess that's where the misunderstanding would have been. Thanks.
Thank you.
Yeah, I can maybe also just add to Bella that obviously with the concentrated plant finished, we could sequence now and see exactly when is the optimal time to start that concentrated plant. With a combination of building stockpile upfront maybe for the first 6 months or a year, and then only starting that. So it doesn't mean that if it's a 3-year ramp up, you're only going to start seeing ounces produce incremental additional ounces from Marinsky in 3 years' time. You could, as quick as within about a 12-month period, start to see additional ounces coming from Marinsky.
Okay, no, thank you.
Thank you. We have a follow-up question from Ntebogang of Investec. Please go ahead.
Thank you again, team. Just a quick one on the Two Rivers production currently. Yes, there were like some geological challenges faced in 1H. I just want to quickly confirm as to going forward, is the 3.09 head grades that was reported for 1H sustainable going forward? Or if you could maybe guide us more on how we see that head grade improving as then the geological issues improve. And then in relation to the Two Rivers Marinsky project, my understanding is that there's around 2.6 billion rand of working capital that needs to be put for it to then be able to get back online. With the current planning, I don't know if it's fair for me to ask if you could maybe provide with just some form of color in terms of how you're going to be spending that 2.6 over the next 2 years, if it is then what is approved. And then I think my last question is mainly around project priority. I just want to have sort of like a greater clarity around your growth projects. I mean, you've got Umkomati, you've got Bokoni, you've got Two Rivers Marinsky project. Are you able to, or even other M&A, and then there's also search also as well as part of your growth projects, right? Are you able to explicitly rank those growth projects in an order of capital priority for us? Yeah, I'll leave it there.
Yeah. You want to comment on the grade?
Yes, if I can go first on the grade, please. Thank you for the question. The grade of 3.09 is a fair outlook of what we could expect going forward. We've moved into an area with split reef, so the grade will no longer be as high as it had been in the initial phases of the project. But the monitoring of the quality of the mining is excellent, and I expect to see the grade remaining where it is. Thank you.
Thank you very much. And then in terms of the project, yes, you are correct. I mean, we've got the trade-off studies that is currently underway in Nkomati. We are now recovering chrome, from the 500,000 tons stockpile that you mentioned, and there's another study as well on the chrome side that is taking place. A study basically to restart nickel. So that is basically Eden Nkomati complex. And you come to Two Rivers. Obviously, the project there that still needs to be concluded is the Merensky. And as Jack says, also, we basically at the tail end of completing that study. The numbers will be put on the table to see what are the returns, confirm the capital that is required, confirm everything, and basically the contributions that project is going to bring to the Two Rivers mine. And then we also mentioned that we already completed the DFS at Bokoni. We're doing the independent review, third-party review. We're doing the value engineering, firm up the numbers. And these three will have to be ranked in the order of priority. And a investment decision will be made at the right time in terms of how we stagger them. The search where we are, we'll most probably say one can say maybe the best guess is come end of June, we should really have the outcome of the pre-feasibility study, whereafter that will really transition into the definitive feasibility study with some regulatory approval process. We see that process being concluded most probably the best case towards 2029. And then if everything else works well, that mine should really go into execution around 2030. So if you look at the project staggering, the surge is still about, last year we used to say 5 years, it's about 4 years now from execution, unless if things are really expedited, in terms of the approval, because we've also seen the response from the Canadian government as far as expediting some of these critical mineral projects.
If I might also just add, Philip, with regards to the affordability on the capital, maybe just in reference with Nkomati, Thandi alluded to the volumes that we are looking at on the potential open pit mining is less than what we did before. And also the fact that the mine was a producing mine, and it was placed on care and maintenance, the ramp-up capital that we would require to put that mine back into operation is not as substantial as completely if we had to go and build a new greenfields mine. So it's certainly, I think, a lot more affordable. And depending on how the economics stack up, because it's open pit, it ramps up production very quickly. It should become potentially cash positive generator in a much shorter period of time compared to, for instance, the Bokoni project, where there's a new concentrator plant that needs to be built and substantial underground development. And with regards to Merensky, I think the biggest amount of money that would have to be spent is on the mining, specifically building working capital and stockpile to consistently be able to feed them all. And with Two Rivers' substantially stronger balance sheet, the forecast is that Two Rivers would be able to fund the full capital required to complete and ramp up Merensky from the strength of its balance sheet and from its cash flow generation without requiring additional funds from the two partners. And that then really just leaves Bokoni that we would have to see, and we're busy with finalizing that work. But we've also said as we are looking at a much smaller study at 120,000 tons. We believe this the right size, which strikes the right balance between capital required as well as sufficient volumes to ensure sustainability and cash competitiveness from a unit cash cost point of view. And we would be able to provide further guidance on that cash flow required to support that project during the next results issue.
Tebogang, is your question answered? Or
the ranking part is the one that's not answered.
Yeah, that's the sense that I got with Tebogang. We're sort of giving you detail on what we're doing at the projects, but we're not ranking them. But if I had to summarize what I think Philip and Jacques are trying to say is that if you look at the current project pipeline, quite a few of these projects are actually still in steady state. And until they're completed and we've got board approval, it's very difficult for us to say, we're going to prioritize project A over project B, right? So that's number one. And I think Jacques was also just trying to illustrate to you that some of the projects are actually going to be able to self-fund because they'll be generating some cash themselves. And some bigger projects like Bokoni and Surge, only once we've got the information in front of us will we be able to make a decision going forward. Because remember, your capital allocation model is continuously evolving. And it would be very premature for us to say we're prioritizing this now, when in 2-3 years' time, once the studies are done and we've got board approvals, the world has changed. So we can't give you an explicit project ranking right now, specifically because a lot of these are still in study phase and don't have board approval.
And as Judge said earlier on, most probably when we come to the next reporting cycle, we will be having, detailed outcome and the decision will have been made. We'll be able to update the market in terms of where we are.
If I may also just add, as part of this analysis, we're obviously doing very detailed cash flow schedules for all of these projects. And then we also look at it on a portfolio view, where we look at from an arm's point of view, what is the forecast cash flow coming in from the operations, what would be the cash required to finance each one of these projects, as well as our other commitments, with regards to returning money back to the shareholders in the form of dividends that we are committed to. So we will be making a very prudent decision in terms of which project will start first, and also maybe we don't do all of them at the same time, just because from an affordability point of view that we do stagger them. And then maybe just one last point. Absolutely no decision made at this time. We are still busy with the study book, and we will review the results as well as the cash flow requirements on the portfolio view very carefully before a recommendation or a decision is made.
Thanks, Steve. Maybe to finish off, my question is maybe around balance sheet, right? So your balance sheet has strengthened to now currently with net cash of around 8.4 billion. And then I'm also then taking into account of the Harmony hedge collar. So one can possibly consider that, I'm not an accountant, but like a lazy balance sheet. So I'm trying to understand, with the excess cash that you guys have, based on my view, what is management thinking around using that cash for future growth? So that's what I'm trying to understand in your projects, the ranking, and also the prioritization in terms of capital allocation. I don't know if I'm making sense.
No, thanks, Tebo, for that question. I might have a different view from yourself in terms of it being a lazy balance sheet, but be that as it may, that's okay. So I think, you're quite right. Our balance sheet has strengthened from June, where we are now, sitting, still in a relatively strong net cash position. But the question you're asking there was actually quite valid and quite, one that we actually deliberate, amongst ourselves with. And specifically knowing that, we've got these projects, we've got this project pipeline. We have, ammunition in terms of, raising additional funds through using a Harmony collar but, at the same time, still looking at the projects that are in the pipeline and seeing those that can, generate cash as quickly as possible, because at the same time, you do not wish to be strained or find yourself in distress in terms of, having to on a commitment and you don't have enough cash. So as, Jacques was saying that, you really do need to look at it from a portfolio perspective. Yes, you're sitting on cash currently, but there is a pipeline. But, there are also other moving parts where, we're looking at the cash coming in from Assmang, in the form of management fees as well as dividends, and, all the other commitments. And then it's really just quite a tight balancing act that, we're going to have to make. So, that also the balance sheet will also be informing, the decisions that we make, in terms of which project we're actually going to proceed with, what is palatable for us and, what we can comfortably deliver on without straining the balance sheet. But, and there again, if we find ourselves in a place where, and I don't think we're there, where, we decide not to go with any project, then, instead of sitting there on the cash, we would definitely look at returning that cash to the shareholders. Because remember, we look at the cash and we say, okay, how can we generate a return more than, that cash just sitting in the bank? And that's where then we'll deploy that cash towards sustainability. Can get you as a shareholder a better return than our weighted average cost of capital. But if not, then the default then say, okay, then let's rather than return to shareholders. I hope that helps a little bit.
Thanks,
Thank you. Our next question comes from Andrew Snowdown of 91. Please go ahead.
Hi there, guys. I am seeing you next week, but I thought I'd ask this question now anyway. And it's just really following on the previous question. The capital allocation slide that you showed, was that the order of priority in which you're looking at things, or were you just saying these are all the things that are considered? Because it is quite an interesting ordering which is displayed. I guess that's the first question. And then the second one, maybe you can talk me through why you put the collar in place in the first place if you're not actually using it. Again, to the previous point, you're sitting on, I'm in the same camp. It's a lazy balance sheet. 18% of your market cap is now sitting in cash. You're also sitting with significant value for your Harmony stake. And yet there doesn't seem to be any real initiative by management to try and unlock any of that value. So maybe you can just talk me through some of that, and again, in line with that, just looking at where you're ranking things like share buybacks, and maybe you can just remind us where, just how much you're allowed to buy back at this point. Thank you.
Thanks. Sorry. So maybe just the first question around the capital allocation guidelines. So the way they are documented there, it's not in order of priority. I think we do have a footnote at the bottom of the slide where we do say that. And then secondly, the question around
why do you have the color if we're not going to use it?
Yeah, I can speak to that. I think that when the collar was put in place, it was specifically to reflect the time and the strategic intent behind it, which I'll share now. But at that point in time, specifically on our PGM and basket prices were a lot more depressed. We're talking about March, April last year. Even though it was our view that the metals were in deficit, either due to the destocking, the substantial inventory above surface, we haven't seen the metal prices were not reflective of the fundamentals, supply and demand fundamentals of the three metals, specifically platinum, palladium, and rhodium. So the whole strategic intent behind the collars, there was at that time even a strong rally up in the gold price. Harmony share price responded quite positively. And we said, given those growth ambitions that we do have, the uncertainty around the PGM prices, how long it will take before it starts to recover, it may be good to just try and strengthen the balance sheet by having some fixed security in place that if we want to, for instance, in future, deploy some of our cash on some of these growth projects that we are that could be value accretive and generate cash above our weighted average cost of capital. We don't want to get into a position where you draw down your available cash on the balance sheet and then the commodity price weakness continues and you start to come under balance sheets stress. So in that case, it's good if there's a facility available, maybe linked to a revolving credit facility that you do have access to. So it's really just capitalizing at the time on the good harmony prices that we saw, and with the benefit of hindsight, it sort of rallied even further beyond that. But and in the context of where we were with the commodity prices and not knowing exactly how long it will take, specifically for the PGM prices to respond. Where we are now, we still think it's a good facility because that strategic intent behind it hasn't fallen away. So if we do proceed with some of these projects, it may still be good to put a revolving credit facility in place. We will obviously use the cash first because that's a lower cost of interest compared to paying interest on the RCF. But at least you've got access to that liquidity on a very short period of time if you need it. Because as a holding company and a commodity producer, especially in today's world, commodity prices are very volatile up and down, and you need a bit of headroom to make sure that you've got you can cover yourself in any eventuality that may happen. I hope that sort of provides a bit of clarity. And the only reason why we haven't used the collar yet is because use of proceeds. We haven't finished the studies yet, and we will do that over the next couple of months. And as soon as we make a decision, then we will look at what is the most appropriate way to utilize that strategically to protect the balance sheet.
Maybe just a very quick follow-up on that, because your actions and the outlook comment don't seem to be marrying up at the moment. Talking about a much stronger second half versus the one you've just reported. And if we look at what the basket price, in particular for PGMs, has done since then, iron ore, I think there's a consensus for you to be lower, but it's still holding up. The rand, yes, was stronger, but it's now been weakening a little bit with the events in the Middle East. The sense is you should be generating very significant free cash flow over the next 6 months, which puts you in an even stronger position. So maybe you could, do you agree with that view first off? What are your concerns at this point? Because the actions by the company don't seem to be marrying with the outlook. Just how good an outlook do you need before you start utilizing that significant cash balance? I guess that's the question.
Yeah, if I can answer that, you're quite right. I think our outlook is also very much in line with some of our peers in the commentary that has made, that we do think in the context at least of the PGM prices, the prices will remain stronger for a longer period of time, which is positive, and that we will, specifically from our two operations, Two Rivers as well as Modikwa, should be at these current basket prices quite strongly cash generative. However, we've seen also how quickly things can change in today's world with the volatility, and we have been wrong in the past where what we've guided on the outlook didn't transpire. So that's why we do think that it is prudent to keep a certain amount of cash or access to cash in the form of an RCF available, that you don't overextend yourself. But the intent is once these projects are studies have been completed, if we have properly evaluated, to make a decision on going forward with them or not. And at that point in time, we'd be in a much better position to see what resources do we need from the balance sheet to be able to support those projects.
Yeah.
Sorry, carry on.
So I just wanted to add something to what Jacques. Yeah, thanks. Just to add to what Jacques said, I think someone said it on the podium earlier. Yes, the platinum operations will be generating cash, but that won't necessarily come through to the center. That cash will be used to fund the requirements of those businesses on Two Rivers, specifically on Merensky. So depending on what that bill is, $2 billion, I'm not sure what it is. will go towards that. And then with Digwa as well, is some, increased CapEx requirements that, that cash, the mine as it is, as it's generating that cash, will go towards funding that. So I just wanted to add that.
And Andrew, the last question was on the issue of the share buybacks. You did ask a question as to whether we will consider doing another share buyback. I mean, as Stu mentioned, it's part of the things that we consider whenever we have a capital allocation, review decisions to say which ones come first. Where we are now, as Jack mentioned, in the next 2 months, there's some serious decisions that we have to make in terms of those 3 project studies. And these things as well is weighed against all the other points that we have to consider. And we do take note of what you raised with our call.
Super. Maybe one last one. As you can tell, we're going to have an interesting meeting next week. Can you maybe give me a sense, because I'm sure you've done the calculations at current spot, the sort of free cash flow that you'd expect to generate, or is that not a number you're willing to share?
No, is that free cash flow in PGM or at group level?
Either way, just an indication, because again, from what we've seen so far and what things have done, if anything, the one number that's surprised everybody is just how strong cash generation is. My worry is that management is coming across a little bit too conservative given the current market conditions. Hence the question.
We have to get that information, so can we give it to you when we see you next week?
100%.
Or we can, we can drop you an email once you have the numbers.
Great. Thank you. We have a follow-up question from Ntebogang of Investec. Please go ahead.
Sorry, guys, just a quick one, right? So if the if the cash flow from the PGM business will be funding these projects, now my question is around dividends going forward. I mean, your dividend policy is based on dividends received. Ferrous outlook seems muted, so you're not expecting as much dividends received from Ferrous as historic levels. And then now the cash from the PGM business, essentially, I'm assuming that now, because it will be funding these projects, it will then not be going to dividends to then African Rainbow Minerals. So how should we then look at dividends going forward for ERI?
We are committed to basically giving cash back to our shareholders. So, and it's a capital allocation decision, but it's a commitment that we have made in the bigger scheme of things. As we weigh these projects that we need to advance, we also basically take into consideration the dividend payment as well.
Yeah, maybe I can add in, Divo. So our dividend policy remains at 40 to 70% of the dividends that we receive from the underlying operations. So yes, as you point out, we might not be expecting, and we were not expecting actually before this rally in the PGM basket price, we were not expecting dividends coming through from those operations for the next 3 years. So thankfully, we're in a better place. But if, those operations are able to fund their requirements and there's anything that's left over, that will obviously be divvied up through to and to our partners. But I think what you can, model, if you need to model, is work with that 40 to 70%. In the past couple of years, we have gone above that range, and that is when, we looking at, the cash that we're actually sitting on, we say, okay, actually we can afford to go beyond that range, and we make that decision. We've made it a few times, quite often. So, but just to be on the conservative side, still use that 40 to 70% as a guideline for the dividends that are within the payroll into insurance.
I think also, maybe just also add on, and I think it just sort of links into the question that Andrew asked before. At current spot prices, and we'll run the numbers, but sort of my assessment is that if the current spot price prevail in the period, the cash generative amount of cash that will be generated above approved as well as that the vehicle is quite substantial. And I think that most likely will be more than what so there will be surplus cash available even after servicing the requirements to complete the Marinsky study as well as the development at the vehicle. So there is a good chance that if the current prices prevail, that there would be cash passed up through the form of dividends to our book.
Yeah. And equally, as Ferris is facing challenges due to pricing and costs, and while we're trying to turn around that business, we can expect lower because we have that center.
Thank you.
Ladies and gentlemen, with no further questions in the question queue, we have reached the end of the question and answer session. I will now hand back for closing remarks.
Thank you, everyone, for dialing in. We appreciate your participation. We will be on the road next week seeing investors. If you've got any more questions or you feel like we maybe didn't answer some of your questions to your satisfaction, please feel free to pop me and send an email, and we'll endeavor to give you accurate answers as soon as possible. But thank you very much, everyone.
Thank you. Ladies and gentlemen, that concludes today's event. Thank you for joining us, and you may now disconnect your lines.